You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Well, last week we did the 300th episode of Options Playbook Radio. I think it was one of the better ones. We huddled up, Mark Longo and myself, answered a lot of great listener questions, and we went into more detail. We went a little bit longer than we normally do, but hey, what the heck, it's worth it for the 300th episode, right? So we had a lot happen since then. The 300th episode kind of started a spark to the downside in the U.S. markets. Obviously, it's the coronavirus that's creating all of this fear so far. And we are going to look at a strategy that's based off of that volatility. When you see volatility in marketplaces like this is when option traders thrive. Now, not necessarily option investors, and you can use options to invest, all about how you approach the marketplace. But if you want to speculate on option contracts, I would rather speculate with the VIX at elevated levels than at the VIX at non-elevated levels. So what's an elevated level? Well, right now we're taping Options Playbook Radio. It is Wednesday the 26th. We're taping a little early. The markets are still open at this point in time. We have the VIX trading, and I'm just going to round off since the markets are open. The VIX is trading at around 28% implied volatility. The S&P 500 index is at 3,120, let's call it 27 approximately. And market's been all over the place. It's been down, it's been up, over a 600-point swing today. Right now we're fairly flat, actually, on the marketplace. We're only down a couple of points. So if I look at this volatility, one of the things that I've always got my go-to, and you probably know this if you've been a fan of Options Playbook Radio or listened to some of my past episodes, you would know that when volatilities are high, I like to look at butterflies. And we look at a lot of butterflies around earnings, but there's no reason to be chasing after any stock right here because we have the VIX up around the 28% implied volatility level. Now, just to rehash, that is the 30-day implied volatility of the S&P 500 index option contracts. That's basically, it's a weighted average. It's always a 30-day index, and it's just something that can track what's going on, the overall volatility of the marketplace, considering that the S&P 500 index is probably one of the most quoted indexes out there and most tracked indexes overall. So when we see that up around 28% compared to even a week ago, we were only up around 18% implied volatility. Average implied volatility on the 30-day index is probably, the mean is somewhere around 15 or 16%. So on the low range, when we get down around 10%, it really can't can't go much lower. Very rarely have we seen the VIX index below 10. That basically means there's zero implied volatility, if you will, in the marketplace. So we have an elevated VIX up around 28% implied volatility. That makes me want to do some trades that will benefit if implied volatility starts going back towards the mean. Now, there's a lot of news out there, and whenever you see high implied volatility, that obviously adds risk to the marketplace. So we're going to try to we're going to approach this with that concept in mind, and we're going to talk about a few trades that we may do as a short-term speculation trade. Now, that said, Options Playbook Radio is never meant to be a recommendation. We're going to look at a fairly advanced trade. We're just trying to learn here. And specifically, we always look at not necessarily our view on the underlying. We're just looking at option pricing concepts, because inside the Options Playbook, we have over 40 strategies. And our whole goal is on the show is to just talk about as many of those strategies as possible. In this instance, we have high implied volatility. We're just going to look at the S&P 500 index. Everybody's quoting the VIX. They call the VIX the fear index. They say the fear index is high. And that's part of the reason why is that when markets go down, people will rush to the S&P 500 index to try to offset some risk, and not necessarily just individual investors, but a lot of institutional investors. And what does that do? That means that they're buying protective puts or some type of strategy where they're buying option contracts to add some form of protection. It could be a put spread. It could be just flat-out puts, a plethora of different strategies. And that has a tendency to drive up implied volatilities, because the more and more they pay for them, the more and more expensive they will get, especially when there is a big known news event like the coronavirus that is just hanging around and adding stress to the marketplace. Okay, so that was a little bit of a review on the VIX and the S&P 500 index. So if I'm going to look at a trade, I like to do butterflies on a shorter term situation where I know that the option contracts eventually have to go to zero. And when you're talking about a large valued index like the S&P 500 index, it's up over 3,000 points. That adds premium to the option contracts. So now we have an expensive underlying, which adds premium. We have a volatile marketplace, VIX trading around 28%. That adds premium. And guess what? All option contracts at their expiration date have to expire. So if you're looking at short-term options, specifically in an index like the S&P 500, you know that if I sell them on a Thursday, it doesn't matter what the implied volatility is on Friday at the close. There will be no more time premium left in the option contracts, just by definition of what an option contract is. So we're going to do a strategy where if the market starts coming back, well, in that scenario, we will benefit largely from implied volatility coming in and also time decay happening in the option contracts. Okay, so what are a couple strategies we could do? Let's just throw them out there. We could look at doing a credit spread, right? We sell a call credit spread. That means we're neutral to bearish on the marketplace. We can get way out of the money on a call credit spread and still receive a decent credit because volatilities are so high. We could also just buy a butterfly and see if we can peg a specific range that the market might bounce back. Now, we could buy one to the downside if we think it's going to get more bearish, and we could buy one to the upside if we think it's going to bounce back and the market's going to be a little bit more bullish going forward over the next week. So it's a cheap way to take a shot as to where you think the S&P 500 index might land. Or, lastly, we can combine both of them. If we combine a butterfly and a short call spread, you basically have a skip strike butterfly. Now, I've never approached it this way. A lot of times we just talk about a skip strike as a standalone trade, but really whenever you're doing a skip strike butterfly, also known as a broken wing butterfly, you are embedding a short call spread inside your butterfly, inside the wings, that will hopefully pay for your butterfly outright. So a lot of times when you're doing skip strike butterflies, you're doing them for a net credit to the account overall as opposed to paying a net debit. All right. So that's the moral to today's Options Playbook Radio. So how do we start? Okay, I'm going to start by looking at a butterfly and then looking at a credit spread that would go along with the skip strike butterfly, and finally we're going to end up at the skip strike butterfly, which is going to be the official Options Playbook Radio paper trade for the week. So how do I pick my strikes? I'm flipping a coin. Obviously, we have no idea. If you think you have any idea where the market's going to go tomorrow, which is Thursday the 27th, it's just not possible. We had a 600-point swing today, over 1,000 points on the Dow over the last 2 days to the downside. There's nobody out there has a clue as to what's going to happen tomorrow. So the S&P 500 index, as I mentioned at the top of the show, is at $3,127 approximately. We're rounding off. I pulled the plug, so the quote's not moving anymore. We're going to keep static quotes throughout, so I'm not going to be looking at whatever I'm quoting you is what the market was when the trade was put on. So I want to know what the long straddle is. If we're going to look at two-day option contracts, options that expire on Friday at the close, February 28th, in the S&P 500 index, I want to know what the marketplace thinks the SPX can move by that Friday expiration. So how do we do that? Well, we look at buying a long put and buying a long call. That's the most at-the-money long put and most at-the-money long call. If we do that, that would be, based off the market, the 3,125 strike call and put. We currently have that trading for $69.85. Let's call it 70. And we're going to say that's our expected move. So that's the line in the sand. That's the over-under. The marketplace thinks that over the next couple of days, this underlying SPX index could easily move 70 points to the upside or to the downside before that expiration on Friday at the close, the 28th of February. So I like to reference it as an over-under. Right? If you think that the market is going to be more volatile, you would take the over. You think it could be less volatile, you're going to take the under. But 70 points is nothing to sneeze at. In a two-day period, that's a 2.2% move in the S&P 500 index. It does not make that move that often, but hence we have an implied volatility of 28%. And if you have a higher implied volatility, you're going to have a higher expected move. Everything goes hand in hand. So we're going to stick to the upside. And we're going to say, all right, first trade we're going to look at, let's say we just want to try to guess that there will be a movement to the upside over the next 2 days. And we're going to say the expected move is in play, approximately. So if we take the $1,126 index or $27 index, whatever, round up or down, and add 70 points to it, we're looking at 3,197 on the S&P 500 index. 3,197. Okay, so that's a significant number because that's basically what the marketplace thinks this underlying index can move by Friday. Now, it doesn't have any regard to direction, so I want to emphasize that. That's just saying that there's some volatility in here. It could make about a 2.2% move in either direction by that expiration. Now, I'm a little bit nervous about that, so I'm going to go a little bit further out of the money. If that's what the marketplace thinks, I'm going to think that the move could move a little bit more. You could go a little bit less, but I'm just going to use this to try to center my strikes. And part of the reason why I'm doing this is I like to use round numbers, especially when we're just trying to learn on Options Playbook Radio. So we're going to do a 10-point wide spread, butterfly spread, and we're going to buy that February 28th expiration. We're going to go just above, one strike above, and we're going to buy the 3,200 strike call, and then we're going to go up and sell two of the 3,210 strike calls, and then buy one of the 3,220 strike calls. Now, for example, that means we would like that underlying stock to finish on Friday at the close as close to $3,210 as possible. That would be our outlook if we think it could make that type of move. So what type of cost do you think that might be? Well, if we bought the 3,210 strike call, That's currently trading at the midpoint. I'm going to round off again, about $5 right now. So you're looking at paying $5 for that call option in the hopes that that marketplace will get to that level and go beyond approximately. That's what you'd be looking at if you bought that. Now, if we do the butterfly, where we still want the market to get to at least 3,210, we'd like it to go there and just stop. But that entire trade at the midpoint right now is trading for a net debit of 30 cents to the account. So all this juice, all this premium makes butterflies cheap. So $30 for a 1x2x1 butterfly, the 3200 strike, 3210, 3220, which is a 20-point wide swath that the market could land in by expiration and basically be profitable on this trade, is trading for $30. Now, you could do as many as you'd like or as little as you like, but as always, we always say that let's do this on paper. But I'm paying $30 plus commission to get into that trade, and that's going to be my maximum risk. If it doesn't fall within the range of my long option contracts, I'm down $30 on this trade. So, like I said, butterflies on expensive underlyings that have a pumped up volatility are just a cheap way to go. So you want to do this to the downside, go 70 points to the downside, pick some strikes, buy it. It should be approximately the same amount as the call side. It should be approximately in general. Now, okay, that's the one trade, not the official paper trade. So now let's look at, well, gosh, what if we could do a credit spread? Let's look at selling a credit spread. We can get way out of the money here on the call side, and the credit spread is going to be, we'd want the market to stay where it's at, or drift lower, or even drift up a little bit, because we're going to go at least 70 points out of the money. So in this instance, the credit spread brings on a little bit more risk. We're going to do it 10 points wide, mainly because our butterfly was 10 points wide. A lot of times I would probably do a 5-point wide credit spread. But we're going to use the strike that we bought to protect ourselves on the long butterfly with calls. We're going to go out, and instead of buying the 3,220 strike call, which we bought in the butterfly, we're going to actually sell that call. And then we're going to go a little bit further out, and we're going to buy the 3,230 strike call. All right? Now, if I do that trade, I can bring in $1 credit to the account. So I have 10 points of risk on this trade, way more risk than the butterfly. Maximum upside that I can make here is $1. That's the maximum that I can pull in from doing that trade. And I guess I didn't mention that on the butterfly. On the butterfly, ideally, I could make 10 points because we have a 10-point wide spread if it stopped right at the strike price. Good luck with that, the one that we sold, the 3,210 strike call. All right, so now here we're going to take on that risk, but we got a high probability of success. We're way out of the money, even farther than the butterfly, because we're actually selling the option contract that we were buying, bringing in a net credit of $1 to the account. And our max risk would be $9 on this trade, and the stock would have to move approximately, or the index would have to move approximately 90 points. Oh, it's actually going to be more than that. It's going to be, 90 points. That's the right number. 70 plus, a little bit more, 95 points. That's about what it would be if I do the math in my head quickly. About 95 points, and it needs to do that in 2 trading sessions. You got all day Thursday, all day Friday. Markets are about to close here. We're getting close to the close. All right. Now let's get to the skip strike. Here is the major fight for the night, for the day, if you will. If this is a boxing match, this would be the primetime show. We're going to look at doing the skip strike butterfly. So what am I going to do here? I'm going to take that butterfly that I introduced to you. That was at a net debit of about 30 cents. Then I'm going to go and look at the credit spread that I introduced to you, and that was a net credit of about $1. And we're going to put that whole trade together. Actually, every strike that we used, if we did it all as one trade, what you would end up is with the skip strike that I want to talk about. Still the same expiration, February 28th. We're going to be buying the 3,200 strike call, same call. We're going to sell 2 of the 3,210 strike calls, and then we're going to skip that 3,220 strike call, right? And then buy the 3,230 strike call. Okay. Now, if you did the long butterfly and then you turned around as soon as that executed and you did the short call spread, guess what? You would have this exact same trade. So that implies that if we did that for a net credit of $1 on the short call spread at the midpoint, and we paid for the butterfly a net debit of 30 cents, then guess what the skip strike butterfly should be? A net credit to the account of 70 cents. And lo and behold, I look at the midpoint and it says 69 cents. Let's just round that up, and we'll say a net credit to the account of 70 cents. So we're selling a credit spread to pay for the butterfly, and that's how that whole trade got set up. So right now, if I look at this skip strike butterfly, the big show, the paper trade that we're going to use, that's official paper trade for Options Playbook Radio, is we're going to buy the February 28th expiration, 2 full trading days until it expires. 3,200 strike call, sell 2 of the 3,210 strike call, and then buy 1 of the 3,230 strike call. We embedded that credit spread. That credit spread is 10 points wide. That means that's our maximum risk minus the net credit received, which was 70 cents. If we can fill that at the midpoint, never a guarantee that we can fill it there. And we're talking about $9.30 worth of risk if the market now goes all the way up to 3,230 points over the next 2 days. So we added another 10 points here. So I think we were at 95 before. So we're talking about a 105-point move in the S&P 500 index in order to lose the maximum on this trade overall. So that was the setup. It was long-winded. I've talked about skip strike butterflies, and honestly, we got a lot of great questions last week about skip strike butterflies, so I thought I'd go in more detail. I'd take the time to do this. And now let's talk about our forecast. If we do this trade, what would we like to happen? Well, if we do it and the market goes down, basically the skip strike butterfly acts like a short call spread. We did this entire trade for a net credit to the account. We have an additional requirement, just like on the short call spread. And if it does go down or stays flat, then all the option contracts in the butterfly will expire worthless, and we'll make that net credit to the account of 70 cents. And so you're looking at $70 on your margin requirement of $1,000, which you didn't have to put up that $1,000 total, and you're looking at about a 7% rate of return in 2 days if the market just stays flat or goes down. Okay, what's another scenario? Market could go up. Now, if the market drifts up, that's actually the ideal scenario. If the market slowly goes up, let's say it goes up 10 points tomorrow, then 20 points, and then eventually by the end of the day, we're looking at it coming within our strike prices of our skip strike butterfly. Our ideal scenario would be that the market would open up about 30 points tomorrow, and then on Friday it would open up another 30 points, about 60 points, and then it would slowly start drifting all the way up to that 70-point level, 75-point level of 3,210. And then it would end up somewhere there. And if that was the case, our upside on the skip strike butterfly, if it stops right at 3,210, right at expiration, is $1,000, 10 points, plus the 70-cent net credit to the account. So I think this is a very interesting alternative, and I don't think that you can really get a marketplace. Like a lot of people see elevated VIX, and I don't care what the underlying is. If the VIX is elevated, usually all the FANG stocks, everything that's been going down overall over the next couple of days, volatility is going to be elevated in it. So whatever underlying you're looking at, this is a very interesting alternative to just selling credit spreads. A lot of people look at the pumped up vol and they say, oh, I want to sell some credit spreads. I want to sell iron condors. I want to sell all these things. But the volatility here is it means that the market can move. So we're just selling it because, there's a lot of juice. But guess what? The juice is there for a reason. So I prefer to do something like this that has a little bit of protection. So if the marketplace does start coming back, it's already got my hedge built into it. Now, Where is my maximum risk, and where do I really get hurt? It almost sounds too good to be true from what I'm talking about here. And here's what happens. If we put this trade on and we executed it right now, and the market opened up big tomorrow, right on the open, and we didn't have a chance for the time value to come out of the option contracts, we didn't get a big drop in the VIX, in the volatility, that market, this trade, the skip strike butterfly, is going to hurt you to start with. It's very schizophrenic as to where you want the markets. If we're closer to expiration, we want the markets to have gone up towards our short call strike price. If it's right away, as soon as we put the trade on and the market starts going up, it's going to hurt us right away. So you're going to look at it and think, wow, the market's going the direction I want it to for my butterfly, but you're going to actually be down on the trade because in that instance, the short credit spread is going to hurt you more than the long butterfly. All right, that's a lot to chew on. So if I'm doing this trade and the market happened to open up to 70 points tomorrow morning, I'm just going to get out. I'm not even going to ask. I'm not even going to, whatever the loss is or wherever I'm at, if I do got a loss in the trade, which I probably would if it opened up that much, if that did happen in the S&P 500 index, we had a 2.2% opening on the market, I'm just getting out of the trade. I don't want the risk of that short call spread coming in. I mean, my main goal here in the most likely scenario, or the highest probability, I should say, probability is never a guarantee, but the highest probability would be that this whole thing's going to expire worthless, and we're going to make 70 cents on that trade. We're trying to make a buck on our short credit spread. We're going to make 70 cents instead on our skip strike butterfly. All right, would love to get some feedback on this trade, long-winded, but I think it was a very warranted Options Playbook Radio. We're going to say that's it for this episode. If you have any questions on this trade, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.